Now, if you're looking to buy an investment property or property for yourself, you're probably wondering whether it's better to buy in your own name or under a trust structure. If you're hearing this for the first time and you're like,
well, what the hell is a trust structure?
In this video, I'm going to showcase exactly what a trust structure is, what are the advantages and disadvantages of a trust structure, and why you may want to consider it. If you're interested, keep watching. Hey guys, my name is Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, cryptocurrency, and financial freedom. Now, the truth is that when you go out and buy real estate for the first time, you're most likely never going to hear about buying property under a trust structure. So in this video, we're going to define what is a trust and why you would want to consider it. And of course, I'm not a financial advisor. I'm definitely not your accountant. I'm not qualified for that stuff. I'm qualified enough to wear black t-shirts, talk to you about nerdy things like real estate, the economy, and the good stuff with crypto and NFTs on a channel like this. So go out, do your own research, talk to the experts in the space when it comes to accounting. If you need help with buying a property, then you can contact me. There's a link in the description below for my buyer's agency. A trust structure is an ownership structure where the legal owner is not the beneficial or eventual owner, i.e. a person or a company owns an asset on behalf of someone else, creating a separation between the owner of the asset and who will gain the benefit of the asset. It's like controlling the asset, but not actually owning the asset. So one of the biggest advantages of trust structures is asset protection. So it's basically a separate entity to yourself, which means in the event of a legal or creditor action against you, they can't actually access the trust because technically your name's not on it. So this is one of those structures that really does benefit anyone looking for asset protection. Another big advantage is the tax component. Now again, you look at the flexibility of distributing funds under a trust means that you distribute the income and the capital gains. So for instance, if you're buying a property under your own name and you go ahead and you make capital gains, that's against your own income. Same thing happens for your rental income. And that means if you do earn a lot, you're paying the highest amount of tax. But then when you go out and buy it under a trust structure, maybe you have kids, maybe you have family members, and that income gets distributed against their own pay-as-you-go tax bracket. So that could be significantly lower and that could lead to higher returns long term because you get to keep more of the money that you generate from that asset. And this is mainly to do with the fact the trustee can actually go ahead and choose where the income is distributed and how much of it. So you can see how quickly it can actually be beneficial when it comes to taxes. Now again, this is a good reminder for you to go and chat to your accountant. If you are looking at building out a portfolio, these are great advantages, but you need to look at the disadvantages and then balance out the argument. Now, one of the disadvantages with a trust structure is that it's very costly to start up and maintain. So what I mean by this is when you go out and you do your own tax return, so an individual tax return, you'll probably pay X amount. But when you go ahead and you set up a trust or a company, you have separate entities, there needs to be a separate tax return done for those companies or entities. So in this case, a trust structure, if you have one property under it, it would be deemed as a separate tax return, which means increase in accounting fees. In addition to that, you've also got maintenance of a few other records that you need, as well as the hefty startup cost as well. Another disadvantage, which people don't realize until much later after the fact, is land tax. Now I've got a video here on this channel about land tax. Definitely go check out this one. And it just explains when you buy property in a specific state, some states have a threshold for which your value could be up to and you're exempt from paying land tax. Now, you know, it doesn't sound like a lot when you're paying $1,000 or $2,000, but if you've got a property portfolio and it's all in the same state, it starts adding up. It's an unnecessary tax that you end up having to pay. So under a trust, you actually don't get the tax-free threshold. What I mean by this is, let's take the example of New South Wales. If there's a tax-free threshold on land tax of $600,000, what does that mean? Well, firstly, it means that you could own multiple properties or just the one property that has the value, the land value, up to $600,000, which won't be taxed. And every year that sort of increases as well as the value of your land increases. But when you go ahead and you purchase something under your trust, from the first dollar of value in land that you have, you pay land tax. This could lead to a large tax bill because you're taxed from the beginning. For reference, if you're buying a property in New South Wales and let's say the property costs $600,000, that doesn't mean the land costs $600,000. It could mean that the land costs $400,000 and then the building on top is what they've determined to be $200K, which means you're still under that tax threshold. If you go ahead and buy it under your trust, then you start paying it for the first $400,000 because that's the land component. Now, if you are learning something from this video, definitely drop a like for the video because it helps support the channel, but also share this with someone that might be wanting to get educated about something as boring as trusts. Another disadvantage is that you can distribute under under a trust the income, but you can't distribute things like losses. Now, what the losses would be is, say, things like depreciation or negative gearing. Now, your investment property can give you these in the form of tax deductions. However, if it's under a trust, that just gets taken forward for any future profits that you're making. But the thing is, the amount that you make versus how much you're getting as a deduction obviously plays out in a better advantage against your own name. But again, your situation might be different, so you need to chat with your accountant to really figure out what the most efficient process is for you. You don't want to end up paying more than you have to, and you also want to be preparing for the next 10, 15, 20 years. You don't just want an immediate fix, you want something long term. And another major disadvantage that people aren't considering is that getting a home loan could actually become a lot more difficult. And the reason for this is there's more paperwork, people don't want to deal with it, and therefore you as an individual as well may just be turned off the idea of applying for a home loan. I know it sounds silly, but when you start owning multiple properties under different trusts, the paperwork really catches up. And that's where it could stop you from actually going and purchasing something in, say, the start of 2020 versus 6 months later. Equally, we're looking at it right now. If you're thinking about buying something under your own name, the quickest you could probably start is right now. But if you tried to do that under a trust, you'd have to get the paperwork in play, and then you'd have to make sure all the tax returns for that particular trust is up to date, and then go to a broker who's going to take more time given that it's under a trust. As you can probably tell, there's no perfect scenario here. You can't just go,
Ravi, just tell me which one I do.
Because again, I don't know your situation. But what's important here is that we know there's choice. We know that there are opportunities out there and options for different scenarios. I'd love to know in the comments down below what you've preferred. Under your own name and why, or under a trust and why. As we try and grow this community, I really want people to learn from each other as well. And so if you can share your experience with either one of those options, that would be amazing in the comments down below. When you're looking at real estate, tax is just one component. Definitely go check out the videos I've been making for the last 2 years on this channel. Get your head around the other factors that play in part when you're actually wanting to purchase. And if you need a hand in finding the right property, there's a link in the description below for Search Property, which is the buyer's agency. I'll catch you guys in the next one. Thanks, guys.